Welcome, ladies and gentlemen. My name is Peter Yusuf. I'm the senior analyst of IronFX. Together we'll be going through a webinar about the week ahead, specifically about October 18th to the 22nd. Now, before we start, we're going to be allowing you for some minutes to go through our risk warning and our disclaimer. And as you're reading, allow me to make a small intro. With inflationary pressures in the US economy being present and Fed's intentions for tapering its QE program being affirmed, we leave behind us a turbulent week. Now, next week is expected to be also quite interesting, given that we get a number of high-impact financial releases from around the world. On Monday, we note New Zealand's CPI rates for quarter 3 and China's GDP rates for quarter 3 as well. Proceeding to Wednesday, we get September CPI rates from the UK and Canada, while on Thursday we get the weekly US initial jobless claims figure as well as the Philadelphia Fed Manufacturing Index for October. On Friday's Asian session, we note the release of Japan's CPI rates for September, while later on we also get the preliminary PMI readings for Australia, Japan, UK, France, Germany, Eurozone and the US. Given the dispersion of financial releases, we see the case for the USD to relent some of its initiative to other currencies next week, thus creating a more balanced blend for traders to utilize. On the monetary front, we highlight from Turkey CBRT's interest rate decision on Wednesday, while before that on Tuesday, RBA is to release the minutes of its October meeting. Also, a wide number of policymakers are scheduled to speak, among which BOE Governor Andrew Bailey and RBA Governor Philip Lowe, both on Wednesday. Please note, though, that markets may start shifting their attention towards the stock markets as the earnings season has started. Starting now with the US dollar, and that would be USD indexes for our chart. Note how the pair was being guided by an upward trend line, which has now been broken, actually since yesterday, and seems to have stabilized between the 94.10 and the 93.70. Now, specific levels to keep an eye out would be to the upside, besides the 94.10, also the 94.60, and even higher than that, the 95. To the downside, we have already mentioned 93.70, lower than that, the 93.20, and even lower, the 92.75, which practically served as a resistance line and has now been turned into support line. Moving now to USD's fundamentals, the greenback, as we have mentioned, is about to end the week lower against its counterparts. After 5 consecutive weeks of being in the greens, it should be noted that the release of the US CPI rates for September reaffirmed the inflationary pressures within the US economy. It's characteristic that the headline CPI rates on a year-on-year level ticked up, reaching once again a 13-year high. On the other hand, the Fed's September meeting minutes confirmed the Fed's plans to actually start tapering the bank's QE program this year, and the tapering to be complete by mid-2022. Attention is now turned to the Fed's meeting on the 2nd to 3rd of November. Yet a number of Fed policymakers are to make statements in the coming week before a moratorium is to be imposed. On a fundamental level, the bottlenecks in the supply chain seem to be an issue for the USA, yet US President Biden seems about to address it, given that the holiday season sales are in stake. In the international political scene, once again, we note the possible thawing of the tensions in the US-China relationships, yet also note that the situation in Taiwan could escalate the tensions. As for financial releases, we note on Monday the US industrial production growth rate for September, while on Tuesday we get the number of building permits and housing starts also for September. On Thursday, we highlight the release of the weekly initial jobless claims figure, as well as the Philly Fed Manufacturing Index for October and the existing home sales for September. On Friday, we note the release of the market preliminary PMI readings for October. Moving now to the pound, and this would be cables for our chart. Now, cable has, at least seemingly, escaped its sideways motion around the 1.36 and has started to aim the 1.3750. Now, important levels to keep an eye out would be to the downside the 1.36, lower than that the 1.3430, and even lower the 1.33. To the upside, we note the 1.3750, which served the pair well and that was around the 25th, 26th of September. Higher than that would be the 1.3875, which was tested a couple of times in the past month, and even higher the 1.40. We tend to maintain a bias for an upward direction. However, we would like to see it breaking above the 1.3750 in order to confirm the bullish movement. Moving now to the pound's fundamentals. The pound seems to have escaped its sideways movement against the USD, as we have mentioned, yet seems to have also bullish tendencies against the euro, as well as the JPY on a weekly basis. It should be noted that the GDP rate for August, which was released on Wednesday, accelerated but missed its target on a month-on-month basis, while the manufacturing output accelerated more than expected for the same month. Also, the employment market seems to have triggered for the particular month as the unemployment rate ticked down and the employment change figure rose substantially. In the coming week, we note the release of the CPI rates for September on Wednesday, as well as the retail sales growth rate for the same month on Friday, along with October's preliminary PMI figures, completing the picture for the UK economy for inflation, growth and consumption. Should the two rates also accelerate, we may see BOE's hawkishness intensifying. On the other hand, any premature tightening of the bank's monetary policy risks undermining the recovery of the UK economy. We note the planned speech of BOE Governor Bailey, which could provide further clues on BOE's intentions on Wednesday. Now, nevertheless, fundamentally, the situation in the UK seems to remain worrisome, as the energy crunch seems to have tightened even further. It's characteristic that Bloomberg reported that 2 more energy supplies collapsed on Wednesday, while it should be noted that 12 utility companies since the start of August have closed. Also, take note of any possible tensions between the EU and the UK, as the Brexit issue, especially about Northern Ireland, seems to be flaring up once again. Moving now to JPY, and this would be USD JPY's 4-hour chart, a clear upward movement, practically breaking all of our prior resistance lines, now turned into support. Please note that the pair has reached a 3-year high. Now we note as levels to watch out for to the upside the 114.55, higher than that the 115.20, and even higher the 116.20. To the downside, we note the 113.70, which served the pair well as a resistance line and now has been switched into a support line. Lower than that would be the 112.90 and even lower the 112.25. Moving now to JPY's fundamentals. JPY seems about to end the week low against the USD, and that despite greenback's weakening, yet also seems to be weakening against the euro and GBP. Now, the political scene in Japan remains quite fluid 11 days after Prime Minister Kishida took office, as the parliament was dissolved and elections could be held by the end of the month. Media report that Mr. Kishida's party may be enjoying some support currently, as a positive momentum seems to be characterizing Japan, yet we'll have to see how the situation actually plays out. Now, Mr. Kishida's party, which is the Liberal Democratic Party, seems to be pushing also for more measures to counter the pandemic, yet also to promote his vision of a new capitalism. Now, the Liberal Democratic Party seems eager to increase defense spending, given the tensions with China and North Korea in the area. The political scene is to continue to be monitored in the coming week, as it created volatility in the past days. On the monetary front, BOJ seems to remain clearly dovish, and it's characteristic that the bank's board member Asashi Niguchi was reported to have said on Thursday that BOJ must maintain its massive stimulus even when the Japanese economy rebounds from the pandemic. Now, as for financial releases, we note the release of Japan's trade data for September. It should be mentioned that the Japanese manufacturing sector, which actually feeds Japan's exports, seems to have been severely hit by semiconductor shortages. It's characteristic that the Japanese government is mulling the partially finance the building of a joint chip factory of Sony and TSCM in the Kumamoto prefecture. Now, as for other financial releases, we highlight the release of Japan's CPI rates for September on Friday, as well as the preliminary Japan manufacturing PMI figure for October. Overall, though, we expect JPY to display once again its dual nature as a safe haven, which could suffer outflows should there be a positive market sentiment. Moving now to the common currency, and this would be Euro USDs for our chart. Now, the pair had been guided for over a month now by a clear downward movement characterized by a downward trend line, which was broken actually yesterday. Ever since we have maintained a bias for a sideways motion, we would like to see the pair actually breaking clearly the 1.1615, not just teasing it as it is right now, and start aiming for the 1.1655 before we switch our bias for sideways motion in favor of a bullish outlook. However, we wouldn't be surprised to see it coming, given that the RSI indicator below our 4-hour chart is above the reading of 50, just below the reading of 70, implying a small advantage for the bulls currently. Now, important levels to keep an eye out would be the 1.1655 to the upside. Higher than that would be the 1.1780, and even higher the 1.1850. To the downside, definitely the current level, which tended to create substantial problems to the pair, is the 1.1615. Lower than that would be the 1.1520, and even lower the 1.1445. Moving now to the common currencies fundamentals. Now, Euro's 5-week weakening against the USD seems to have hit a halt, as the pair has turned north this week, probably as a result of USD weakening rather than Euro strengthening. It's characteristic that the common currency seems to be losing ground against GBP and has stabilized against CHF for the current month. Now, fundamentally, the situation in the Eurozone remains stressful, given the energy crunch the zone is experiencing. Russian President Putin's recent comments that Russia is ready to meet its contractual supply obligations and is willing to increase gas supplies to Europe did not seem to ease market worries. On the monetary front, ECB President Lagarde reiterated the view that inflation is driven by temporary factors. However, she also mentioned the possibility of the price pressures could become more persistent if supply bottlenecks last longer or wages rise more than is currently anticipated. Also, it was leaked by a private meeting of ECB's chief strategist Philip Lane with German economists that the bank expects to hit its inflation target in 2025. Now, as for financial releases for EU traders, we note the release of Eurozone's final HICP rate for September on Wednesday, as well as Eurozone's preliminary consumer confidence for October on Thursday. The highlight, though, for Euro traders is expected to be the release of the preliminary PMI readings for October of Germany, France, and the Eurozone on Friday. Now, should the readings rise further, we may see the common currency getting some support near the end of the week, as they would imply an even faster expansion of economic activity in the area and vice versa. Moving now to the Aussie. AUD USDs for our chart, a clear upward trend line, despite some false breaks twice. Still maintaining the bullish sentiment, just broke above the 0.7420 line. Now, important levels to keep an eye out would be definitely to the downside the 0.7420, which used to be a resistance line, now turned to support. Lower than that, we would note the 0.7335, which practically served the pair also as a support a few days ago. Lower than that, we would also note the 0.7280. To the upside, we note 0.7475, which is also the highest point in our chart. Higher than that would be the 0.7540 and the 0.76. Now, moving to Aussie's fundamentals. High commodity prices seem to continue to support the Aussie, despite Australia's soft employment data being released for September. On the monetary front, RBA's dovish stance could act as a counterbalance for AUD strengthening, yet that seems to have been well priced in by the markets for now. Nevertheless, we highlight the release of the bank's October meeting minutes, that's on Tuesday, and RBA Governor Lowe's speech on Wednesday, which could gather some interest among AUD traders. On Monday's Asian session, we note the release of China's GDP rates for Q3, as well as the industrial output and retail sales growth rate for September. Now, China's industrial output and GDP rates on a year-on-year level are both expected to decelerate, and if so, could foreshadow difficult days ahead of Australian exporters of raw materials. Now, it's characteristic that China's September trade data indicated a widening trade surplus, yet on the back of slowing imports, which was not good news for Australian exporters. Overall, though, we tend to maintain our bullish outlook for AUD for the time being, yet we advise caution. Other than that, we would also note the release of the preliminary Pmi readings of Australia for October on Friday. On a fundamental level, we highlight the US-Sino as well as the Sino-Australian relationships, and any intensification of possible tensions could weigh on the AUD, while any easing of the tensions could support the commodity currency. Moving now to the Canadian dollar, and this would be USD CADs for our chart with a clear downward trend line characterizing the movement, which is currently aiming for the 1.2330. A level to keep an eye out to the downside. Lower than that would be the 1.2250 and even lower the 1.2160. To the upside, we note, besides the 1.2425, the 1.25, which served as a resistance line well. That was around the 11th of October. Higher than that would be also the 1.2580, which more or less tended to serve as a support line, yet now is turned into resistance. Moving now to CAD's fundamentals, the CAD seems to remain strong against the USD, supported by oil prices, actually rising oil prices. On a fundamental level, we expect oil prices to continue to support the loonie as long as they continue to rise. It should be noted that oil prices continue to rise despite US oil inventories ballooning across the recent AP and EIA readings. Seems that oil traders eye the possibility of high natural gas prices forcing users to switch towards oil as primary fuel source, thus creating additional support and pushing black gold's price even higher, as also mentioned in our last report about the oil market. That was yesterday. On the monetary front, BOC's confidence seems to remain, and given the stellar employment data for September, we may see the bank accelerating its QE tapering plans, probably also moving to an earlier date any possible rate hikes. We tend to remain bullish for the Canadian currency currently, and we highlight the release of Canada's CPI rates for September. That's on Wednesday, focusing mostly on the core rates. Now, should the rates accelerate further, we may see more pressure being exercised on the BOC to actually tighten its monetary policy even faster. On second base, we would also like to note the release of Canada's retail sales for August. That's on Friday. Now, before we leave you, as a general comment, we would like to make a reference to the Turkish Lira. Now, the Lira has been weakening for the past few days, and that's practically pushed the Turkish currency to reach a new record low against the USD. The situation is highlighted by the Central Bank of Turkey interest rate decision, which is expected to be released on Wednesday. Now, the bank refuses to start tightening its monetary policy and even proceeded with a rate cut of 100 basis points of its 1-week repo rate, that's from 19 to 18%, in its last meeting. Now, it should be noted that inflation has reached almost 20% on a year-on-year level. That was in September. Now, the bank's dovish policy seems to be a result of President Erdogan's pressure on the bank. It's characteristic that the Turkish president dismissed 3 of the bank's policymakers, 2 of which were mentioned as to have opposed the last rate cut performed by the bank. The bank was expected to reverse its previous decision in the coming meeting, yet after the overhaul of the bank's board, such a scenario is being highly doubted. Now, should the bank proceed with another rate cut, as President Erdogan is reported to be wishing, we may see the TRY reaching new record lows, yet should the uncertainty of the situation persist, it could have an adverse effect on the Lira in the meantime. That should sum it up from us here at IronFX. Best wishes for solid trading.